Your Excellency, the Minister for Primary Industries, my close friends from the palm oil industry, my colleagues from the Indian industry, many of whom are here today, ladies and gentlemen. I am delighted to be back in Malaysia, participating in this palm oil trade fair and seminar in the beautiful capital city of Kuala Lumpur. I have many friends in the palm oil industry, and I have reason to be indebted to this very successful industry in your great country. I have worked in this industry for 35 years. I must say I don't look it, but I have been around for 35 years. Our company, Godrej, is very much a palm oil pioneer, being the first Indian company to introduce what was in those days a new product, refined, bleached and deodorized palmolene in consumer packs to the Indian housewife in 1977. People don't know, but the very first invitation I received to speak on price outlook came from this country, from Malaysia. It came from what was then called the Kuala Lumpur Commodity Exchange, the KLCE, which used to run the very successful futures market. And it came from a gentleman who was at that time its general manager, Raghbir Singh Bharat. Let me also pay a rich tribute to two very close friends I have in the palm oil industry in Malaysia. One of them is not here today, Mr. M.R. Chandran, who used to run the MPOA for many years. And of course, a man who I have known very well since 1981, when both of us were young men, Tan Sri Dr. Yusuf Basiron, who can rightly be called Mr. Palm Oil. I am also most grateful to the MPOC for inviting me to participate in POTS Kuala Lumpur today. I've always been very open in my admiration for the promotional work that the Malaysian Palm Oil Council and its precursor, the MPOPC, have done over the last many years. Frankly, in export promotion, the MPOPC has no equal in the world. Today, I'm going to restrict myself to speaking on the world palm oil scenario, since my friend Dr. Bharat Mehta has already covered the Indian scenario this morning in his usual brilliant way at the forum. No one knows India better than Dr. Mehta. And may I say that it is a great pleasure for us at the Solvent Extractors Association to have joined hands with PORAM last year in a landmark seminar-cum-workshop on dispute resolution, and how timely that seminar took place, because 1 year later we have had a drop in prices and a few disputes arising because of that. The economic scenario for 2012 was dominated by various kinds of monetary easing or note printing. The last one was in September, when Chairman Ben Bernanke announced QE3, or what many people call QE infinity. All eyes are now fixed on the outcome of the US presidential election on 4th of November. The situation in Europe causes worries to all of us. Even the mighty German economy has struck a soft patch, it would appear. In a nutshell, I can sum up the macroeconomic situation as flat to negative for the developed world and medium growth for the developing world. And as I have been saying for the last few weeks, the country that impresses me most and which enjoys the best scenario today is India. Because of the fact that the reform process in India has been reinstated. And as I correctly said at my last paper at Globe Oil India in Mumbai last month, the rupee is going to get stronger, and that is going to be a virtuous circle for the Indian economy. The currency gets stronger, interest rates are reduced, and economic growth accelerates. I also remain optimistic on China. So both China and India will grow well during this coming year. Both countries benefit from falling commodity prices. Inflation has been a problem for both China and India. Now, inflation comes under control in both countries. And both countries are engaged in pulling large chunks of their population out of poverty and into prosperity. Malaysia is also well placed and likely to grow, I believe, at around 5% this year. Your government is also working hard on the reform process. This, ladies and gentlemen, is after all called Asia's century. I'll now come to developments in the palm oil world. The recent release of September figures by the MPOB has vindicated what I have been saying in the last several months. September production came in at 2 million tons, and stocks have now reached about 2.5 million tons. At this stage, I would like to pay tribute to the MPOB because they have been faithful to their mission to report true and correct statistical information regardless of the market impact. If they continue like this, they will soon develop a reputation like the USDA for probity and propriety. Every Malaysian should be proud of the performance of the MPOB. I have often been asked in the last 4 days as to what I think about the new export tax regime introduced by Malaysia last week. For the long term, it is exactly the right response to the situation that was created by the new Indonesian tax regime the previous year. You have been, and when I say you, I mean the Malaysian industry, have been fortunate to have an extremely astute and knowledgeable minister who is cautious, careful, and clever. When I wrote this speech, I did not know that the minister was going to attend. So these are true words. As I have said before, this was an extremely difficult situation for Malaysia. Indonesia had taken what we call first mover advantage. And the Malaysian government naturally has been very cautious and, may I add, prudent in its response. Such situations do not call for a knee-jerk reaction. But at the same time, ladies and gentlemen, let me also say that the industry in Indonesia is much younger, the industry is more adventurous, and it is much more hungry for success. On the other hand, the industry in Malaysia is more mature and often prefers the serenity of the golf course. In a situation like the present one, Malaysia had no alternative but to emulate Indonesia and create a similar export tax structure which is what they have done. I often say a joke about the Americans, and I think it also applies to the Malaysians. Eventually, they will do the sensible thing after having tried out all other alternatives. What about the burdensome palm oil stocks? That is the other question that I am asked. Will this new export tax regime get rid of the burdensome palm oil stocks? It now appears fairly certain that Malaysian palm oil stocks will reach or exceed 3 million tons on 1st January 2013. If prices are held artificially high, it will be counterproductive, and stocks on 1st January could be much higher than 3 million tons. Or the number of 3 million tons can extend up to 1st March 2013 if prices are held artificially high. The recent difficulty in boosting exports must serve as a warning to Malaysia and Indonesia. Both countries began what I call a major export push from August onwards. The result has been now high stocks and full pipelines in almost all destination markets. Even in India, which was the best performing market of this year, we are now suffering acutely from high-priced, heavy inventory and a lack of storage. Ships these days have to wait until there is room to discharge into shore tanks. Ask any shipper in Malaysia or Indonesia, and he will confirm that the turnaround time for vessels has increased, and this is one of the reasons for the pedestrian performance in exports. I have been asked the question, will the new export tax structure in Malaysia clear away these burdensome stocks? My answer is absolutely not. The current situation has been brought about by strong production, flat edible demand, collapsing biodiesel demand, and rising stocks. To reduce stocks in Malaysia, you must pay respect to two short English proverbs. The first proverb says, a bit of short-term pain can lead to long-term gain. And the second one says, the cure for low prices is low prices. And now the next question you will ask me is, how low do prices need to go in order to clear the stocks? It is common knowledge that a phantom called the 5 o'clock phantom has been operating on and off in the Bursa Malaysia futures market. I know Mr. Chong is smiling at me. He doesn't know. The phantom is invisible. I say the phantom operates on and off because he tried unsuccessfully to hold the market at 2,800 ringgits but failed. In the last few days, he has been seen again occasionally trying to hold the market at 2,500 on the third position. Let me tell you, ladies and gentlemen, this attempt will also fail. My advice is drop the phantom and please listen to the free advice offered to you by a lifelong friend of the Malaysian industry standing in front of you. Given the current fundamentals, the BMD futures on the third position should be allowed to fall to 2,200 ringgits. Let CPO prices go to 749 CIF Rotterdam. I will explain to you the logic. Malaysia should immediately remove all export taxes on a short-term basis and also remove quotas. Malaysian refiners will be very competitive and will be able to work at full capacity. With zero export duty, palm exports will expand automatically. At this level, Indonesian export tax also becomes nil. So there is a level playing field for both countries. And in fact, Indonesian growers and plantations will benefit because they will get more rather than less. With better infrastructure, which Malaysia has, more efficient ports, which Malaysia has, there is no doubt that Malaysia will win a greater share of the export market. It is, ladies and gentlemen, short-term pain for long-term gain and a win-win situation. At that price of 749 CIF Rotterdam or BMD at 2200 on the third position, palm will be so competitive that new energy demand will come strongly back to the palm market. Palm oil will be competitive for blending into fuel for cogeneration of electricity. Palm biodiesel will be super competitive and will go for what is called discretionary blending. That means the user blends it of his own free will without need for a mandate or without need for a government subsidy. European prices of gasoline and diesel are such that palm biodiesel will move on its own strength without need for any mandates. This is how stocks will be cleared to less than 2 million tons within 3 months starting today. I know I am speaking to an audience of producers, so it is very difficult to convince producers of the logic of low prices. But, ladies and gentlemen, a level of 2200 ringgits for a couple of months is not an oppressive level for this industry. Each and every CPO producer will make a decent profit even at 2200 ringgits. And as stocks decline, you will pave the way for better prices in the future. Let me now give you some observations on the production profile of the industry. My expectation is that Malaysia will produce between 18 million and 18.2 million tons of CPO in 2012. I was expecting a peak in Malaysia in October. It is possible that there will be logistical problems and what I call slower harvesting, which will mean that the peak will get extended into November. October-November production may not be the same, but November will be higher than what we had expected earlier. The recent news that El Nino is faltering and not likely to happen is heartening for the industry. Recent rainfall data also suggests the same. Accordingly, we have to rework our estimates for 2013, and I hope to announce my estimates as I do every year at the Bali conference in the end of November. I confirm what was said by earlier speakers today, that the Indonesian production appears to be doing better than expected this year, and we will definitely exceed my estimate of 27.5 million tons for 2012. Now, Indonesian statistics are like Indian statistics. It depends on what your starting point is. I am at 27.5, other people are at 26.5, some are at 28. But whatever it is, Indonesian production is going to be at least 2.5 to 3 million tons higher this year than last year. The current anti-dumping inquiry launched by the EU in the case of biodiesel exporters from Indonesia and from Argentina will take about 1 year to complete. At the end, the EU, if it finds a case, it will levy an anti-dumping duty with retrospective effect. That means the duty comes into effect from the date on which you received the letter from them in the first place. Therefore, it will remain a cloud hanging over the use of palm products in biodiesel for export. And that is why, ladies and gentlemen, this demand for cogeneration of electricity is very important for palm oil. And that demand will only come in meaningful measure at 2,200 ringgits, not above that. Because electricity generators also look at the economics of the electricity that they eventually sell. I have some frank comments to make. With great respect to my hosts, I shall take the liberty of speaking freely and frankly on 1 or 2 points. Let me say emphatically that any talk of cooperation between Malaysia and Indonesia on a long-term curtailment of plantations and plantings is meaningless. It will not happen, and it is also not right to restrict production of a food item when current prices are still very profitable. Besides, Malaysia and Indonesia are fierce competitors for markets, and therefore there is no merit in trying to cooperate when they have already shown you 2 fingers 12 months ago. I also want to speak about the discount of palm to soybean oil. I have been asked about the big discount between the price of palm oil and soya oil and why this has not resulted in a bigger switch of market share to palm oil. First, we must realize that palm oil already enjoys a very big, very large market share in what I call swing markets like India. Price-sensitive markets is where palm oil wins. And already palm oil enjoys a very big market share. So the scope for further accretion of market share is very limited. Secondly, most markets have their own compulsions with regard to taste, historical or cultural preference, and climate. Palm has a slight disadvantage, as you all know, in winter months. And these stocks have come at the time of winter. So that disadvantage plays a disproportionately large role at present. Most markets also do not switch very easily from one oil to the other oil merely on price, except markets which are traditionally price sensitive. Therefore, I have always cautioned people not to expect a major shift from soya to palm, particularly in the months of September to February, purely on the basis of price. We must also remember that soya oil is a byproduct of soybean crushing, and therefore, in markets or countries where soybeans are produced and crushed, there will always be a domestic preference for soybean oil. Finally, in the last 2 years, we have seen a massive increase in the production of sunflower oil. People of my generation are staggered to see the amount of sunflower seed that is now produced in Russia and the Ukraine. 3 times, 4 times what it used to be produced in the old days of the CIS. What has happened now is that sun oil has become extremely competitive, very often selling at a discount to soybean oil. So the switch has taken place from soya to sun rather than from soya to palm. You could say that the journey from soya to palm has been stopped by sunflower oil getting into the center. So these are the reasons why there has not been a major switch from soybean oil to palm oil despite the large discount of palm oil. I have also been asked, what chance of import duty levied by India on CPO? I would say that it will happen, but not immediately. Indian domestic prices for soybeans have been falling and farmers are not happy. But the Indian government will wait until domestic inflation numbers turn lower. Once that happens, and that will happen because prices are coming down of commodities in general and the rupee is getting stronger. Once local inflation comes down, then it is possible that a small protection will be extended to Indian farmers in the form of a small import duty, but nothing to upset the pricing power or pricing mechanism here in Malaysia. My normal method is to discuss incremental S&Ds, the tonnage by which supply increases compared to the tonnage by which demand increases, and then come to a price outlook. In late 2011 and early 2012, as you all know, I was very bullish and I was forecasting CPO to go up to 4,000 ringgits by the end of June 2012. As you all know, the market peaked at 3,628 ringgits on 10th of April, and after that, it has been downhill. My forecast has since been abandoned, and many people have asked me why I got it wrong. For a start, the macroeconomic situation in the world, and particularly in Europe, was very unsatisfactory. Even developing countries like China, India, and Brazil were slowing down. Also, I was far too optimistic about world growth. But the biggest disappointment in my incremental S&Ds came in biodiesel demand. If you remember my paper at Price Outlook in Kuala Lumpur in March, in my incremental S&Ds, I had built in an increase in biodiesel demand of 3 million tons. That turned out to be a massive overestimate. I am convinced today that the consumption of vegetable oil for biodiesel actually fell. It did not grow by 3 million tons. It did not grow by 1 million tons. It has actually fallen this year compared to last year. I am still working on this data because in the biodiesel world, data is difficult to come by, and to actually put a finger on it is not as easy, and I want to be absolutely sure of my figures before I release them. But I am convinced that in the oil year, which started in October 2011 and finished in September 2012, the use of vegetable oil for biodiesel in the world as a whole decreased rather than increased. So we lost at least 3, if not 5 million tons of demand that we were hoping to get last year. In my next speech, which will either be, I have 2 speeches lined up for early next month, and in one of them, either at the Golden Jubilee of Kuwait in New Delhi on the 4th of November, or the 7th CIOC in Guangzhou on the 8th of November, I hope to come out with up-to-date incremental S&Ds for the oil year 11-12. And that will show you how wrong I was, how wrong other analysts were, and that is the reason for the problems of too much supply and flat demand in the vegetable oil space as a whole, not just in palm. I believe traders and analysts will be shocked at the figures that I hope to present. What are the main culprits for this degrowth in biodiesel consumption? The first culprit has been what is called double counting of used cooking oil and non-edible oils like tallow, grease, and waste products. One of the reasons why PFAD is so much in demand, and PFAD is almost the same price as CPO, is the fact that in few selected markets, PFAD is classified as a waste product and is eligible for double counting for biodiesel. On top of that, countries like the United Kingdom have allowed interchangeability of biofuels. That means if there is a mandate for using X amount of biofuel in transport fuels, you can interchange between ethanol and biodiesel. Now, everyone knows that ethanol is much cheaper than biodiesel. You can get ethanol from corn, you can get ethanol from wheat, you can get ethanol from sugarcane. Sugarcane ethanol is today the cheapest. So, by allowing this interchangeability, in some markets, the use of biodiesel has become zero. Now, these are things that I'm going to explain in more detail in my next paper because I'm still working on these things. But this is the reason why biodiesel demand growth has degrown, decelerated, and this is the primary reason for this oversupply and higher stock in the vegetable oil space. The future also does not bode well. By the future, I mean the coming year, the year which has just started. This anti-dumping duty inquiry is going to hang like a sword on the people who buy palm methyl ester. As a result, the use in biodiesel may not be encouraged beyond mandated limits. We will have to see. Unless if it is cheap, in which case people will take the risk that if we have to pay an anti-dumping duty, it's all right. The product is cheap. The EU has also, as you all know, come out with a rethink by which they want to limit the amount of biofuels to be used in transport fuels on a long-term basis. They have embraced this idea, which I personally do not approve of, this idea called indirect land use change. It's a very abstract concept which some American professors have come up with. In my opinion, the evidence is just not there for this to be adopted. But the EU has, unfortunately, embraced this idea. So with all these, I would say that it is important that we try and clear off the high stocks, because if we wait for nature to take its own course, it will be a very long time before the high stocks can be brought under control. I will quickly give a summary of my views on other oils. The recent USDA report of 11th October has come and gone. We have a big rationing job to do, but I am afraid traders were too bullish about soybean prices. Once the US harvest is done, and once we get into a South American weather market, we will see a recovery in bean prices. The benefit of that recovery in the first half of the year will go to soybean meal. And in the second half of the year, the benefit will come to soybean oil. Sunflower seed crops in Ukraine and Russia are lower than last year, but they are still better than what we were expecting. Sun oil will continue to give stiff competition to soybean oil in its traditional markets. And very importantly, we must watch the currency of the Ukraine. The Ukraine is a country with a few political problems, an election which is expected, a leader of the opposition who is in jail, and it may be that their currency may come under pressure. Weak currencies make for weak prices. We must keep that in mind. On rapeseed oil, the canola crop in Canada is lower than expected, and we expect that canola prices will remain at a premium, and in fact, canola prices may even support soybean oil prices, particularly in the domestic US market. And for lauric oils, I would simply repeat that I do not see a good outlook for lauric oils. As I have said in 2 previous papers, the outlook for lauric oils is bleak because they do not have edible support. They are mainly industrial oils. With those words, ladies and gentlemen, on price outlook, I feel that there is a growing feeling that the cyclical bull market in commodities is over. Agricultural commodities like soybeans, wheat and corn have a bullish story, and it remains to be seen if the funds will continue to drive these markets or whether the funds will move to other markets like equities, because the funds normally don't stay in individual markets for very long. I think energy prices are also important. With slower growth, we should look for lower crude oil prices. There are good prospects that the United States will start exporting gas as well as crude oil in the near future. However, most energy traders that I speak to tell me they are friendly to energy prices for 2013. Perhaps they are building in a significant political risk premium, particularly with regard to Iran. So it is quite possible. Bearing in mind all that I have said, my short-term forecast for CPO prices is a level of 2,200 ringgits on the 3rd position of the BMD within the next 4 to 6 weeks. Prices must enable energy demand to kick in and for the vast tonnages to be sucked out with energy. In the new year, we can look to higher prices, and I've got many papers lined up between now and the new year when I'm quite happy to change my forecast depending upon the evolution of the market. Whilst I have not had much to say to cheer the bulls, let me say that the outlook for the palm oil industry has never been brighter. We are in a unique sweet spot where we provide food to humanity at a reasonable price and at the same time provide employment and a decent living standard to millions of our people. I send my best wishes to the Roundtable on Sustainable Palm Oil and its deliberations at RT10 next month. We are very fortunate to be part of this great industry and to participate in its prosperity. As I have said, I am only advocating a bit of short-term pain to get long-term gain. And with those, ladies and gentlemen, words, thank you very much to MPOC, and I wish you all good luck and God bless.